What's up, Louis? It's Guys here. Hope you are doing great. So my previous video was a quick analysis video of the 5 most bought stocks in June based from information of Easy Equities. And in the video, I asked if you have a specific stock that you want me to analyze. And Nicole, one of my subscribers, asked me to analyze Amazon stock. So Amazon is a company that I haven't really looked into that much. So this is definitely going to be a learning session for myself, and hopefully you can follow along. This is definitely a company that has received a lot of hype in the past. So we need to decide whether this is a stock that we want to invest in. Maybe you are already a shareholder, or maybe you are considering buying Amazon like me or Nicole. So with that said, I hope that you can follow along, and I'm going to jump straight into it. So first of all, what I've done is I've downloaded Amazon's latest quarterly results. Because I'm not too familiar with everything that's going on, I thought that this would be a good starting point. And I'm just going to quickly scan through it, and hopefully we can get informed. So we can see that net sales increased by 9%, which is a good indication. Amazon has 3 parts where they generate income. First of which is North America segment, then the international segment, and then the AWS segment, which is Amazon's web services, which is a really big part of Amazon's income. So we can see that the North American segment increased with 11% year over year. We can see that international segment only grew by 1%, which is basically flat. And then if we have a look at the AWS segment, we can see that it has a pretty decent 16% year over year increase. This is all pretty good indications except for international segment, and we'll quickly have a look at how big the international segment is for Amazon. Something that I personally like to look at is operating income, and this is really important, especially with big businesses, to know that the company is actually growing their operating income. So with the operating income, we can see that the income increased to 4.8 billion, which sounds great. But then we have a look at the North American segment. The operating income was almost $1 billion, compared with a loss of the previous quarter of $1.6 billion, which was the first quarter of 2022. So that's a pretty big loss in the previous quarter. Something that we need to take into consideration. Luckily, they are growing, and I know that Amazon said that they are working on their margins to increase it and minimize expenses, because a company like Amazon obviously has a lot of sales, general and administrative expenses. Then we can have a look at the international segment, where they had an operating loss of $1.2 billion. This just means that in the international segment, although they are generating a lot of money, they are still losing money at the end of the quarter. So they lost 1.2 billion this quarter. The previous quarter was 1.3 billion. So they're definitely working on their margins. But the question is this good enough? Then the AWS segment, the operating income was 5.1 billion compared to the operating income of 6.5 billion in the first quarter. So this is something that a lot of investors did not like, because it's a decline in AWS, and it's just a sign that the growth there is slowing down. So we can see that the operating cash flow overall increased with 38%, which is great, to $54.3 billion in the trailing 12 months. Then another important thing is the free cash flow. So I like to invest for operating cash flow and free cash flow. And I know the previous quarter they lost quite a lot of money, so they say that the free cash flow improved to an outflow of $3.3 billion for the trailing 12 months, compared with an outflow of 18.6 billion. So they still have quite a big free cash flow issue, and it's mainly due to capital expenditures. The previous 12 months of 18.6 billion is quite intense, so it's definitely improving. So what we can see here is that Amazon is working on their margins, and they're improving the operating cash flow and their free cash flow. So North America is basically the biggest income generator for Amazon. Like we can see here, in the last 3 months, they generated a net sales income of $76 billion, which is up from the 3 months ended from 2022. So this means there's growth there. But just have a look at the operating income in those 2 years. So the previous year they took a loss, and luckily this year it's positive. So they're definitely improving it. But this is the biggest way that they generate income, and they only from $76 billion. The operating expenses is $75 billion, meaning they're only making around $898 million from $76 billion. So that's not great. Although it's improving, it's not a great sign. Again, with international, they are actually still losing money. And AWS is one of the biggest contributors to their income. And the scary thing is that this is actually decreasing from the previous year of 6.5 billion. And the last quarter, it was only 5.1 billion. So this is definitely something to take into consideration. What we're going to do is we're going to jump to Stock on Lock. This is the platform that I really like to use because it's quite easy to navigate and to work on the platform. And we're just going to quickly have a look at the insights on Stock on Lock. So we can see here that they have an insight score of 3.03 out of 5, which again is quite average. The quick blurb says that it has a negative free cash flow of minus $8.57 billion, which means it's currently losing money. It's not a good sign. However, it has grown revenues at 9.87% over the past year, which suggests that sales are increasing. We just need to remember that this might be due to the fact that Americans aren't really spending, and a lot of people over the world are kind of like turning around their cents and trying to budget as much as they physically can. So it might improve going forward. It has a 4.4 analyst rating, and Amazon has a financial health that is pretty good. It has a cash runway of 90 months. The current ratio is below 1. For those of you that watched the previous video, anything above 1 is good. Anything below 1 is not too great. It just means that their current liabilities is more than their current assets. And then when we have a look at its growth forecast, so revenue is increasing by 9.87%, which is average. Gross profit is increasing by 16%. But the operating income is decreasing by minus 32%, and this is something that is very bad. And then again, net income is decreasing by minus 79%. So operating cash flow at least is increasing, and that we saw that on the previous earnings release, but it's still not too good. The operating margin of Amazon is basically 2.54%, which is very bad. And the operating margin shows how much of the revenue is converted into cash that the operation produced. So for all the money that they make, how much can they actually convert to cash? This is your operating margin. And this is 2.54%, which is really not good. The management, I'm not going to comment on that right now. And then the valuation. So the valuation, it shows that the price to earnings ratio of 306 is above the 5-year average of 90. So its price to earnings is really quite high. It's 306 at the moment, meaning that you are paying 306 times more for each and every dollar that the company earns. So that's a pretty high evaluation. So let's jump into some more details to see if it's worth that valuation. We'll go to the financials quickly. So we can see that their revenue over the last couple of years has been growing tremendously, which is quite impressive. And that's why I'm not really sure about the company, because they have a lot of revenue growth, but the operating expenses just keeps increasing. And something that I really don't like about Amazon is their selling, general and administrative cost. So we can have a look at how much that has been growing with its revenue. So obviously it makes sense. If your revenue increases, your operating expenses is going to increase, but the operating expenses is increasing quite tremendously. Then when we have a look at the yearly net income, we can see that they made a loss in 2022, and that's not a pretty good sign. So yeah, I'm not sure if that's going to change. The balance sheet, I just wanted to show you something good about the stock is they have quite a decent retained earnings amount, and this has been growing tremendously over the last couple of years. It's flat or basically down from the last year, but that's $83 billion in retained earnings. So retained earnings is simply all of the amount of profit that the company saved for itself. When you create free cash flow, you can either reinvest it into your business, pay down debt, or pay it out as a dividend. And once all of that is done and you still have money left, that is known as retained earnings. So this is a very good sign that they are retaining their earnings. Then we just quickly want to have a look at the cash flow statement, and we're going to scroll down to free cash flow. So this is the yearly financials, and we can see that the free cash flow the last 2 years were negative. And this is a bad sign. Basically, most of the free cash flow goes to those three things of investing in the business, paying out dividends, and then paying down debt. And it's a good sign that Amazon is still investing or reinvesting in the business, because they are trying to grow their revenue, but at what cost? So they're growing their revenue, but the bottom line is decreasing. And this is, I'm not sure if this is something that I personally like to see. Again, if we have a look at the operating cash flow, which is basically the money that the business generates from its operations, we can see that that has been flat over the last 2 years, and it has been decreasing from the year previously. So that's also just something that we need to take into consideration. So this is just the insider transactions, and this is all people that sold the stock at a certain price. So we can see that they sold a pretty decent amount. All these people, these are all sales, except the last one is a grant, and they sold around 130, 128, 125, 123. So around, let's say, $125 dollars, a lot of people sold. This is just something that we don't really like to see a lot of insider trading, because it means that the directors or CEOs or whatever think that the share is overvalued. So next we jump to our freeform tool, so we can have a look at the operating cash flow, and we can see that they are currently trading at around a price to free cash flow of 24.24. So if we scroll down, we can see the low of Amazon is around 18, and the average is around 28, and the high is around 45. So currently the stock is trading close to its average price to operating cash flow. Again, we can see that the revenue just keeps increasing, and let's type in net income. So you can see how much the net income is increasing, and basically how their net income is just flat over the last couple of years. And we can even see that it has been actually decreasing from here. So this is not a good sign. So what we can also do is, I'm going to jump to the discounted cash flow model. So usually what I like to do is to discount free cash flow, but obviously the company is not generating any free cash flow, so we have to use operating cash flow. And we're going to do this over a number of 5 years, because it's very difficult to predict and assume so many things over a period of 10 years. So let's work with 5. The app basically uses an average metric growth rate. But what I'm going to do is I'm going to jump to simply Wall Street, Amazon over here, and we can click on future growth. So it shows that its earnings per share should be growing 10% per annum. So let's use a metric growth rate of 10%, assuming that they'll be able to execute 10% operating cash flow growth over the next 5 years. And we'll use a price to operating cash flow of 24, like we saw in the previous screen. So using all of these numbers with a 10% discount rate, we can see that currently the stock's fair value is around $123. So the upside is around 52% in the next 5 years, which is a compound annual growth rate of 8.84%. It depends on what type of investor you are, if you're happy with this type of return, and obviously all of the numbers that are used here are just assumptions, so it can change. Let's say they are able to grow at 15%. We can see that the upside is around 90% and a compound annual growth rate of 13%, which is obviously much better. Personally, I don't think they will be able to grow at 15%, but I don't really know and I can't predict if that's going to happen. So this is just another quick indication to see what it is actually trading at. So the current price is around $129. The fair value, in my opinion, is around $123. So it has a bit of a downside of 5%. So if you can buy around this price, I'm sure that you will be able to make some pretty decent returns going forward. I'm not sure over the long term. I really do not know what's going to happen. I'm just going to quickly show you what Simply Wall Street says, and I'm going to click on their valuation part, and we can see that the company has a pretty high valuation. And if we scroll down to the share price versus the fair value on Simply Wall Street, we can see that it's currently 2.7% overvalued. And this is basically what this platform says. So they say that the current price of $129 is overvalued by 2.7%, and they think the fair value is around 126%. So they changed their valuation a tiny bit, but it's pretty close to what I see over here. And I think that I agree with this valuation. So with that said, obviously all of the assumptions that we made are just forecasts, and things can change and they can release great results, and this can obviously change everything tremendously. What I just like to see is a company that has a very high operating cash flow margin, as well as the ability to generate free cash flow. Those two things are really important for me as an investor. So let me know if this is something that you look at too. Is this company something that you are considering buying? Let me know what you think about this video, and I hope to see you guys in the next one again.